My name is Nathaniel Imprim, GAMFIN's training coordinator. Today's webinar is hosted by GAMFIN and CAPLAS through our partnership with MasterCard Foundation to strengthen Ghana's non-banks. Today's webinar is hosted by GAMFIN and CAPLAS through our partnership with MasterCard Foundation to strengthen Ghana's non-bank financial sector. The program is called First Plus, which stands for Financial Institution Resilience and Strengthening. There are two presenters for this webinar, Zibrim and Endona. So we will hear from Zibrim, who has over 15 years experience in banking, both in Ghana and outside Ghana. And then we followed by Donna Nails. She has been providing finances and risk management assistance to banks and non-banks financial institutions across the world, including assisting them through crisis situations. Right now, she's working a financial institution in the Balkans to develop the asset liability management system. Zibrim, please, the floor is yours.
I don't believe he's on.
I'll start.
Okay, Donna, please take over. Thank you.
Thank you, Nathaniel. So today we are going to talk about the exciting topic of asset and liability management.
I'm sorry, Zibrim just joined.
Okay.
Right.
Okay.
So Zibrim, please, you can take over, please. Thank you.
Thank you. Good afternoon, audience. Hope everybody is doing well. Today's webinar basically is going to be on asset and liability management. As you are all aware, Ghana is growing in numbers and we need to strengthen our financial institutions. Currently in Ghana, we are talking about 30.8 million population with about 23 commercial banks and over 144 community and rural banks, and a couple of savings and loans companies, among others. Here in Ghana, we're all aware that about 70% of the population are said to be unbanked. So what it means is that we have only 30% who are actually doing business of banking with us. And we all know what is happening in the global world, especially in Ghana. The current macroeconomic climate condition in Ghana, coming from the COVID-19 pandemic, which we are struggling to get out, the effect of Ukraine and Russia war, among others, have resulted in high inflation. Currently, we are looking at about 53.6% of inflation in the country, which is quite not good for us. The cedi is currently depreciating, and it has slumped to about 21% against the dollar in 2023. This means that in real challenging times we are facing in the country, and as a financial institution, we must take a proactive measure to manage our assets and liabilities in order to remain resilient in this challenging macroeconomic climate we find ourselves in. The situation now with the rural bank is not any different from the mainstream commercial banks. If we look at a casual look of the total asset of our bank assets in terms of assets of the financial institutions, i.e. the rural bank, basically we realize that almost all of us are pushing about 60% of our assets into investment portfolio, i.e. the government securities, bonds, and other things. So this presupposes that we are dwelling more on the investment rather than on the MSME or the main activities of credits. If you do 60% of your asset in investment, it means you're left with 40%, which is quite okay, but it has its own challenges. Indeed, the securities, especially the government securities, were deemed to be risk-free. We all learned in school that when you invest in the government bonds and securities and all that, T-bills, it's risk-free. However, with the current challenges, we all realize that the risk-free is no longer risk-free. So even if you invest in the supposed risk-free assets, you still might face some little bit of challenges in the future. Indeed, those securities, especially the government securities, which would seem to be risk-free, and one can be guaranteed of a safe return, even if it is lower than the bond market. At least now it's no longer the case. This means that in terms of limits and concentration of our assets, most financial institutions are exposed, higher portion in investment and lower in loans, other than the loans we have to grant. So taking cognizance of the current turbulence in the bond market, as well as the government securities, the financial institutions in Ghana have a higher proportion of their assets in the investment securities and are likely to face some level of challenges. As we speak now in Ghana, the Eurobond restructuring has been extended. We all know about that, right? And the talk on the debt exchange cancellation is also ongoing towards the bilateral whatever between the government and then the bilateral partners. So far, Ghana has only partially completed the domestic debt part of the exchange program. We all know what is happening. People are screaming on the street and all that because of the investment being locked up. And this is also affecting the banks because the banks or the financial institutions or the rural banks have also saved or invested their money into this kind of security. So if it's locked up, it means the bank liquidity in terms of assets has also been locked up. Ghana is trying to restructure most of its public debt, estimated at around 576 billion Ghana cedis, which is equivalent to $45 billion by end of November 2022. Local bond holders have been asked to voluntarily exchange 130 billion of debt for new bonds that will pay between 8.35% and 15% interest, compared with an average of 19% on old bonds. So what it means is that Ghana stands to ask external creditors to write off as much as 50% of the debt it owed them, far higher than 30% the government initially considered. So to date, local investors have exchanged 87.8 billion or 67% of bonds under the restructuring for new securities against an overall target of 80%. This clearly shows that the financial institutions must have to really look at their assets and liability management more seriously than ever. In the past, it was okay for us to go into the bond market, to go into the government securities, but now we have seen what is happening. So there must be some level of portfolio diversification in terms of assets. We have to have a strict investment policy, and come up with some level of concentration limits among others to manage our portfolio. So with the current macroeconomic situation, if we should conduct a strict test, that is a stress test on our financial institution, i.e. the commercial banks, and even the rural banks that we work with, we would have realized that only a few number of financial institutions in Ghana will be able to survive because of liquidity challenges. Our monies are locked up in the investment. This is why an asset and liability management are very key and critical now. Recognizing the challenges financial institutions are facing today, strengthening a financial institution's overall risk management is more important than ever. Successful asset and liability management ensures sufficient liquidity, like we have just realized. If we had all planned, we didn't know, but this is a risk we need to manage. If we all knew that when we invest into the securities, it will lock up, I'm sure we wouldn't have done that. But this is risk we need to all manage at a point in time. The rural banks to fulfill all these obligations on time and in the minimal refinancing costs. And for you to be able to respond to unforeseen macroeconomic challenges, you need to plan. So this webinar basically focuses on effective asset and liability management practices, including the role and responsibility of assets and liability management committee members and reporting requirements. So at the moment, we have a specialist who is going to take us through. However, the key message is that we have invested so much into an investment portfolio, i.e. government treasury bills and bond markets as financial institutions, i.e. Mainstream banks and then the rural banks. And now that money is supposed to be restructured, and so we may not have enough money to be able to operate. So this webinar is timely, and to do this is our resource person, Donna, who is a seasoned development finance and risk management specialist, who has a very good industry knowledge in the subject, and she's going to take us through the asset and liability management to be able to manage our bank's assets, so that next time when there's such a crunch in terms of investment portfolio, we still have a backup which we can be able to run around to have enough liquidity to manage our financial institutions. On that note, I hand over to Nona, who is an expert to take us through this asset and liability management. Thank you so much.
Thank you, Zebram. As Zebram said, I'm going to talk today about asset liability management. I'm going to talk to you about some prudent practices, meaning I'm not going to tell you best practices. I've been around a long time, and I started out as a banker. I started as a small business banker and then went into the risk management department, working with ALCO. And unfortunately, in the last 15 years, I've been called in a lot of crisis. A lot of times when the financial institution didn't have an ALCO, wasn't looking and understanding and managing their asset and liabilities. What they were doing, I will tell you, they were always doing reports for the regulators. And sometimes these reports were very good. But guess what? Management wasn't thinking about these reports. They weren't critically thinking what they meant. They were just filling out the form, sending it to the regulators. And then when there was a crisis in external crisis in their environment, in their countries, then they were dealing with some problems. So these are just prudent practices. One thing I want to state. We will be giving you this presentation, and we're going to be giving you a number of tools, even some templates for some policies that I recommend. So I just want to let you know, I'll point out, you will be getting a number of things after this seminar. And hold on, I got to get to the next slide. There we go. So what is asset liability management? It's actually developing a framework that's going to govern your balance sheet management, to maximize your risk-adjusted returns within the governance board's risk appetite and regulatory requirements, okay? So one important thing here is what's included in this framework. What do you mean by framework? The framework is actually a border. It's a fence of policies, procedures, benchmarks, and limits. So this gives management an understanding of what they need to do, what reports they need to do, what type of benchmarks and limits they have to hold until. And this is the regulatory requirements, but also what is established by the board. So let's talk about specific risk, what risks are monitored by ALCO. Okay, that's the Asset Liability Committee. We have the liquidity risk, which is talking about the risk that the financial institution can't meet its meet its commitments. It's kind of like having enough cash to pay your bills, to make additional loans. This is just about managing your cash investments, liquidity. Then we have maturity risk, which is the risk that the financial institution cannot pay its obligations that are due on a timely basis, or grow if they want to grow their financial institution. It's interest rate risk. And this is the risk that interest rates will increase or decrease, and that these increases or decreases will hurt your balance sheet and will also hurt your income statement, your net income. It's exchange rate risk. So if you have you have different type of currencies on your balance sheet, meaning maybe you have some loans, or maybe you have some debt in USD or in Euro, there's some financial loss if currency rates change. For example, if there's a devaluation of the cedi, something that you've experienced before, this will look at, this is that type of risk. But the real goal of ALCO, this committee, is that there should be no major shocks to earnings and equity. I mean, we're in the risk business, right? We are financial institutions. We give out loans. We take in deposits. There's risk, but we just want to make sure when managing all these risks that there's no major shocks to the earnings and to the equity of the financial institution. Okay, so Bank of Ghana has a number of policies and guidelines that are established for risk management. This is one example I was just looking at for rural communities and banks, because what I was doing when I was looking through all your regulations was to understand where the Bank of Ghana was discussing and dictating maybe the establishment of an ALCO. This was one regulation where they said that for the governance board needs to set liquidity limits, but also they said that the establishment of an ALCO committee, an ALCO, is recommended for medium to large RCBs, with the small RCBs only having to have an officer. So that was the only area that I saw where ALCO was actually mentioned in the regulations. Now, I'm not a regulation specialist, so hope I might have missed something, but that was only where I could find it. Interest rate risk, this guideline, again, they talked about the governance board setting tolerable limits for interest rate risk management. And that the management system should be established to assess the effects of interest rate changes on both earnings and the equity of the RCB. I mean, this is what ALCO is going to do. The governance board is going to set these limits, and then the ALCO committee is going to be looking and ensuring that the financial institution is adhering to these limits. And if they're not adhering, if there's a reason maybe they can't adhere to them, they're going to be going to the governance board and talking to them about if there's some special steps that need to be taken. So what is ALCO's main responsibility in quick synopsis? Monitoring the organization's tolerance levels. Yes, I'm going to repeat that one more time, the tolerance levels. And then they make appropriate recommendations to the governance board. They establish the procedures, okay, how that the timely reports are going to be given to the governance board. Normally on a monthly basis or quarterly basis, it's given to the governance board to understand that the institution is complying with these limits and tolerance levels. They look at the financial management policy. This is a policy, and I'll talk about it a little later, that is going to set the parameters of these tolerance levels, the policies and procedures that ALCO needs to be adhering to. And incorporated in this management policy will both be the regulatory requirements and also standards that are set by the governance board. Some other responsibilities are pricing of assets and liabilities, repricing. For example, I'm working with a financial institution in the US, a non-bank financial institution in the US, and interest rates are rising very sharply in the US. So they made a decision recently in their ALCO committee to raise their loans, new loans that are going out the door by a 0.5 percentage point, because they realized their margin between what the cost of the money that they're funding and the loans was getting squeezed. So they needed to kick it up to make sure that this margin was a little bit higher. The other responsibilities is deciding on the investments in various assets and liabilities. There could also be the review of new asset or liability products and understanding that liquidity levels will be acceptable to meet projected needs in the future. So ALCO in practice, let's talk about it in practice. It's really looking at specific risks under different possible scenarios, including, here's some very specific questions. What happens if an unexpected large volume of depositors withdraw their deposits? Okay, that all of a sudden we call it a run on deposits, which I've seen at a couple institutions where they literally locked the doors and they didn't let their clients come in because they were having so many clients show up, they didn't have enough cash to actually pay the depositors, and it ruined their reputation. And the institution lived, but it was a very, very, very difficult time. What if loan repayments occur faster than anticipated? Maybe clients who have loans that are out 12 months, 24 months, all of a sudden start paying back very quickly your loans at your financial institution because somebody else is offering some cheaper loans somewhere. What happens to your interest income when that happens? Because you thought you get all these interest payments in next month, but all of a sudden they're not there because the client repaid. What happens if interest rates rise suddenly by like 100 basis points or 1%? What happens to your income statement? And what happens if the cedi devalues by 20% against the US dollar. I know you've had to deal with some devaluation issues, situations last year. And this is something that you always have to keep thinking on a continual basis, because there's always going to be fluctuations in currencies. So ALCO needs to be critical thinkers. They need to ask questions. Again, the worst ALCOs I've seen, or I shouldn't say worse, but ones that are, I mean, all they do is they look at the reports, they say, okay, they're given to the regulators, that's it. They're not asking critical questions that need to be asked. And that's the situation, that's the institutions that will have a problem later when their crisis situation comes about. So where is this committee in the organization? So if we look at this, you have your governance. Normally you have a governance board. There will be an audit committee where you have an internal auditor that sits in the institution working on internal audit, but they answer to the audit committee, right? Then you have usually a board risk committee, or sometimes you cannot have a board risk committee, and the chief risk officer and a risk management answers directly to the board, but many times it answers to the board's risk committee. And under this risk management kind of unit or area, you have an ALCO, the committee, that's looking at the specific risks we talked about: liquidity, interest rate risk, currency risk, and then you have the other risks. So that's how it fits in. It's in the institution. I know there are some financial institutions that have ALCO up at the board. So they'll have an ALCO up at the board level, but they also have an ALCO that sits there in the financial institution. Because in the financial institutions where they're doing a lot of work and they're looking at the reports and making some hard decisions, always reporting back up to the governance board. You don't do anything substantially different than what's in your policies and procedures unless you talk to your governance board. But this is usually the month-to-month, ALCO usually meets month-to-month making the decisions. So the ALCO members usually are voting members are a chief executive officer, chief financial officer, or your financial officer, risk manager. If you have a chief investment officer, somebody doing head of treasury. Non-voting members, usually you have like a chief credit officer, head of lending, maybe your chief operating officer. They will be attending. Now, where I worked in my bank, the ALCO members actually were the same members as the risk committee. So what would happen is the ALCO committee would meet first, which is the same members, and they would take the minutes for the ALCO committee, start the meeting, end the meeting, and then they'd stop that meeting and then start the risk committee meeting. Per our US regulations, you had to have a separate ALCO committee. It could be the same members as your risk committee, but you just had to hold two separate different meetings for it, because ALCO has some very specific areas and risks that they're going to be looking at. So the ALCO agenda, we have review and approval of minutes of the prior meeting, including, very important, actions that were undertaken that were required from the prior meeting, if there was some actions that needed to be completed. Discussion of the current and future economic conditions in financial markets, because you're always going to be looking forward. I mean, you're going to look at what's happening now, but you're also thinking, okay, do you think interest rates are going to go up? How much do you think interest rates are going to go up? What's happening with inflation? How is it going to affect your clients? So ALCO really needs to think about these economic conditions and how they're going to affect the financial institution and its clients. Discussion of any regulatory changes that could affect the financial institution from the ALCO's perspective. Then you're going to talk about liquidity, short and long-term liquidity. Interest rate sensitivity. So interest rate movements, how are they going to affect the balance sheet and the income statement? You're also in this area, you're going to talk about the investment portfolio mix. And then you're going to talk about currency risk. Are there any mismatches that can affect the balance sheet if there's any kind of devaluation of one of the currencies that you have on your balance sheet? So policies, I talked about policies. So the two main policies that will be dictating asset liability management is a funds management policy that usually also includes an ALCO charter, which states who's in the ALCO, what it's responsible for, and then an investment policy that looks more at your investment portfolio. The nice thing is I'm going to give you samples of these after the webinar you're going to receive. I'm not saying use this policy exactly, because there'll be different instruments that you can invest in your country. But these are good, I think, very good examples of what you should include in a funds management policy and investment policy. So one important thing, I keep talking about target ratios and guidelines, benchmarks and limits. You're going to be sick of those words by the end of this seminar. But one thing that I think the funds management policy does that's so important is set these target ratio and guidelines. Okay. A few of them. So this is an example of a client that I worked with. They had a loans to deposit ratio. And what they were saying is loans outstanding before the allowance for loan losses divided by total deposits had to be 90% to 105%. What that was saying is for all the deposits they bring in, they want to be using them mainly for loans. This was a very mission-driven institution that really wanted to serve small businesses where they were working. So the board said, we want most of the money from the deposits from our clients' deposits. We tell them we support small and medium-sized businesses, and we're going to put them in loans. So we need to adhere to this percentage so we can tell them, yes, majority of your money is going, or all your money is going into loans. Liquidity ratio. So this one ratio they had is cash and liquid investments, something that could be investments that could become cash in less than 30 days divided by total assets. They wanted this always to be 10 to 20% of total assets. Currency risk exposure is that a net open position of any one currency divided by equity had to be plus or minus 10%. And I'll show you this later to be more specific what I mean by a net open position. And then the other thing they did that we normally do with ALCO is we do interest rate shocks to understand what happens if interest rates go up or down substantially, and how that's going to affect especially how it's going to affect our net interest income. So, for example, one kind of normal target is that over 12 months, what is the percentage effect on net interest income if there is a 200 basis point shock change in interest rates? That means a 2% plus or minus effect on interest rates going forward. If that happens? And what this financial institution stated is that they have a 10% tolerance measured quarterly, meaning if they look at 2% interest rate, going up or down, the net interest income could only be changing by 10%. Now that's not saying that if it goes up 15%, if the change is 15%, that they have to change something. There has to be a discussion, right? And they have to make a decision. And they might say, you know what? Interest rates in our country actually have been going down. We don't think that this plus 2% is actually going to happen. So we're not worried that there's a 12% or 15% change quarterly. But it's something that's got to be discussed and then documented in minutes. So again, the targeted ratios are recommended by management, but approved by the governance board. And some of these target ratios will also be completed by the regulators, will be recommended. So liquidity risk monitoring. I'm going to very shortly talk to you about this because next week we're going to have a seminar, a longer seminar, specifically, not longer seminar, 45-minute seminar on liquidity risk. So today I'll just take one quick slide. So when the ALCO is discussing liquidity risk, they're going to look at a short-term liquidity, kind of your daily, weekly cash flows over 30 to 60 days. And they're also going to have a number of ratios. One, for an example, is that loans to deposit ratio they have to adhere to. They're going to look at long-term liquidity. Are we going to be able to make our obligations, in the next 2-3 years? and are also going to have a liquidity crisis contingency plan. We'll talk a lot about that next week. And we're going to talk about balance sheet growth also. If you want to grow, how are we getting the deposits or debt to be able to put out more loans? Now we're going to talk about interest rate risk. So this is the risk, again, that arises from potential changes in interest rates that can adversely affect the value of the organization's assets and liabilities. And this could be a mismatch of when the assets and liabilities mature, or it could be because some repricing characteristics. And I'll discuss that and give you some tools. So maturity risk gap analysis. I'm going to explain this now, but then the next slide, I'm going to show you an example. So just to let you know. So this is going to measure the difference between the value of risk-sensitive assets that mature during a period, like a month, against the value of the risk-sensitive liabilities that mature over that same time period, so 1 month. And what the policy will say is they're going to set a limit on what we call the gap, the cumulative gap to equity. One normal limit I see is plus or minus 12% on a cumulative basis. But you also have to think then, okay, when we're looking at this, are there some off-balance sheet tools available for like lines of credit? But let's talk about an example so you understand. Here is a maturity gap analysis. Many of you probably in finance or risk management or senior managers have seen this before, but I'm going to explain it because I know there's some people that are on this seminar that maybe don't have this kind of understanding. So what is this report? Is taking your balance sheet, your assets and your liabilities and your equity, and it's putting it in buckets of time based on when it matures. So for example, this second column, which says equal or minus 1 month, that's all the assets and liabilities that mature within 30 days, okay? So this is saying at this standpoint, this financial institution had 11 million of cash. Cash never matures. It's always cash, right? So we always put that in the first bucket. Then they have investments of 35 million that were maturing within 30 days. And the loans maturing during those 30 days was 19.8 million. Okay, so a total of 67 million was maturing or was liquid within 30 days. On the liability side, we had some term savings accounts. So these are savings accounts that have a time that they mature, and that was 3 million. The demand deposits are deposits, of course, that you can get at any point, and that was 4.6 million. And then they had a lot of loans. They're funding mostly with loans on this financial institution, and they have 20 million of loans that are coming due. So if we look that they had 27 million of liabilities and equities coming due. So if we minus the 67 plus 27 million, 67 million plus minus 27, you get that gap, and that's 39 million. That's a positive gap because you have more assets than liabilities, right? So we have more cash and more loans and et cetera that are maturing to pay that 27 million of debt if we needed to, okay? So if we look at that gap and we look at it as a percentage of equity, it's 19%. Now, if we go to the second month, which is so that would be 31 to 60 days out, you have 49 million of a lot of investments that are coming liquid. You have 21 million of loan portfolio, so you have 71 million. But then on the liability side, you don't have a lot. You only have 7 million of liabilities. So if we had to add that 39 plus that 64 positive, you have 103 million, 100 million of cumulative gap, which is 49%. This is all dandy, right? It seems like everything's going to be okay. But what we do have, I wanted to point this out, is we have 1 month that we have negative. So if we go down to 4 to 6 months, you have a negative 27% of gap because you have 120 million of loans payable coming due at that point. Okay, you still have a positive cumulative gap, but you have a lot of debt to look at. So an asset liability committee would be looking at this. Then we would say, what are some other factors to consider? Behavior of the of depositors and of borrowers. So for example, maybe this has a lot of consumer or micro loans that roll over. So those loans, of the loans that mature every month, maybe at least 50% are refinanced, or those people get new loans. Maybe that reason we have so much investments in 2 months is last year, there was they purchased a lot of T-bills, 12-month T-bills, and they all mature at 49. They're going to roll those investments back over. Maybe the loans payable, you also have that 120 million in 4 to 6 months, but they've been talking to the investors, and the investors know that 100 million they're going to give them some new debt. So this is a discussion. It's not just something to look at, you fill it out, you move it on, but something to think about, also the behavior of the depositors and investors. This is a report I saw, MNB 700, your required monthly reporting. And I notice you do have a gap analysis, this bottom layer that's taking the assets minus liabilities, but it's a percentage of total assets. So that previous report, I'm going to give you that, but you have this one. And just because I say gap is a percentage of total equity doesn't mean you can't use this one and set a tolerance level of gap as a percentage of total assets. What I'm saying is, don't need to redo all your reports. You have some things that you're already giving to the Bank of Ghana, and use those reports, but maybe set tolerance limits. So then you have the discussions. Interest rate gap is the difference between assets that reprice during a period versus liabilities that reprice. Again, you've got to set some limits. We also got to look at the impact of interest rate movements on net income that you expect in the next year. And we got to do some stress testing. Here's another gap analysis, but this is interest rate gap analysis. So you may ask, what is the difference between this interest rate gap analysis and a maturity gap analysis I just looked at? The difference is this is repricing. This is putting the assets and liabilities based on when the interest rate changes. So for example, maybe the financial institution has some debt on its balance sheet. It matures in, let's say, 2 years. However, the loan agreement says that the debt is going to be repriced monthly, or every quarter, let's say quarterly, every 3 months, based on a certain rate, certain T-bill rate or something like that. So this is not about maturity. This is about when the interest rates reprice. Now, one financial institution I work with, everything is fixed except one. They have one debt, some debt that reprices. So that's what it really almost looks the same, the gap, interest rate gap analysis maturity. So one thing I want to point out here is if we look at, I think it's the month, if we go to months 6 to 12, okay, if we look at the rate sensitive liabilities, you have 9.7 million that is coming due. You have some big term deposits, right? 6.5 million. Again, you just don't look at this and get worried. There'd be a discussion of the behavior of your clients with term deposits. Do they normally just roll them over and stay with the financial institution and then, say, okay, I'll put it in another 3 months or another 12 months? Or has there been some significant changes in the market, and you can expect many people will want their term deposits back? Again, this is the discussions that need to be had. Some interest rate considerations. Of course, your policy needs to set limits. That's where I'm saying again, you should plan and look at some scenarios of some distress situations. For example, that all your term deposits people will, when they come due, people want them back. How will that affect your equity? How is that gonna affect then your future net income if you think about that rolling over? And the other thing is, if your investments are in a trading portfolio, they have to be marked, they should be marked to market needed, because then the interest rate movements will show how they will impact on the income statement. This is another tool I'm going to give you. This is actually a tool that even our regulators in the US recommend, that some small, like not our large city banks, but some smaller financial institutions. It's a very simple tool to look at interest rate scenarios effect on net interest income. I just developed this with a client. And what this is, let me explain this to you. This is the financial institution's net interest income over the next 12 months, broken out in periods. So they take the gap analysis and they're able to say, okay, 1 to 30 days, we're going to earn 469,000. 1 to 3 months, 438. 3 to 6 months, 675. 6 to 12, about $1 million. The total over the whole year is 2.6 million. And then let me show you the scenario. So scenario A, they say, what if the average rate on the customer's loan portfolio decreased by 1%? Okay, so their rate was 24%, but what if it goes down to 23%? And based on the tool I'm going to give you, which is very simple, they show that 2 million will be decreased by 129,000. Okay, so some other scenarios, if we go down this stress scenario B, we can see if interest rates on the liabilities to the banks increase by 1%. So right now, I think they were paying for their bank 6%. How about if it goes up to 7%? And again, they figured out, and it's a very simple tool I'm going to give you, that their interest income will go down 92,000. So what does that mean? So if you remember, I talked about, like, there has to be some understanding and some tolerance levels. So if, you know, this, we're saying if the bank liabilities go up by 1, and if the average rate on the loan customer's portfolio decreased by 1, okay, you would have about, if you add the 129 and the 92, a $229 million effect, or sorry, 100,000, 229 plus 92, about 230, 220, 100,000 effect on the net income. And what would be your tolerance levels is, if you set these scenarios, what would the tolerance level be? How much can your 2.6 million of projected income go down that with this change in interest rates that your institution would find acceptable? The most important thing is to set these scenarios, set some sensitivity ones that maybe are realistic, but then also set some stress scenarios. I mean, this is a great tool just to have a discussion of interest rates, how this affects, and what will happen in ALCO, to think about what's happening, you know, and how this will affect your institution. FX risk, I got to talk about this briefly. So this is monitoring and addressing the risk associated when currencies change, right? If you have some USD and you have the Chetty on your balance sheet, and what happens to your balance sheet if and the impact when there might be some devaluation of one. You have some key ratios that we call this a currency gap ratio that I'll show you in the next slide. And the benchmark is usually single currency exposure should not exceed 10% of equity. So here's my FX gap analysis. As you can see, it breaks out asset and liabilities and equity in USD and the local currency, right? So this financial institution has majority of everything in local currency, all their assets local currency, but it looks like about a third of their debt, loans payable, is sitting in USD. Okay, so you can see that if we look, that it's got to be they do have some open exposure, right? If we didn't have any exposure, we would have the asset of USD equaling the liabilities of USD, but they don't. Now, the situation with this institution is that actually they're required by their regulators to keep all their cash, all their loans in local currency. They're not allowed to have anything in a foreign currency. And they got a loan from an international bank that gave them a loan in USD. So they had to live with this. They will do some analysis to see if the local currency devalued to the US, how that would affect it. But they've chosen this risk. The ALCO understands this, the board understands this, so they've accepted this risk. One thing I will say is that you could also consider putting some provisions for devaluation expense on your balance sheet and income statement to understand if you think there's going to be some devaluation in some issues with that going forward. To end, because I know there's some questions, I'm not going to go through these because you're going to get this, but these are some questions you need to be asking. Management needs to be asking themselves if there's an ALCO established. Also, that benchmarks and limits are set by the governance board in addition to the regulatory ones. And then there's some specific ones regarding liquidity risk and interest rate risk. So what really, honestly, in a nutshell, what is the goal of ALCO? There should be no surprises, meaning ALCO should understand interest rates are going to go up and down. There's going to be some devaluation. There's going to be some, maybe not run on deposits, but some months where people are going to take more deposits out. But we shouldn't have surprises. We should understand this and be ready for it in case it happens. And I want to thank you at that point. Nathaniel?
Okay. Thank you, Donald, for an awesome presentation of ALCO. I was taking some notes myself that ALCO establishes a framework, and that framework contains policies, procedure, benchmarks, and limit risks, maturity risk, interest rate risks, and then exchange rate risks. And then ALCOs, many of the participants have paid attention. But Donald, these participants that if you have any question, you can post it in the chat box, and then it will be addressed in the course of the webinar. And then in webinar, so this asset liability management webinar we just had is a part of 4 series. So the 4 series, the risk management coming off on the 14th March, that is next week. After that, we have strategic risk management, and then we also have effective risk management. So you can put that on your calendar. However, it is also in the flyer that you receive. All the 4 webinars are on it. So I want to urge you, if you have any questions, you can post it on the chat box and then it will be addressed. But then Donna, this question just came up for RSL, that is Rural Savings and Loans. What will the role and responsibility of ALCO be when thinking about non-loan assets, that is mainly investment, on the balance sheet? Can you please address this for us?
Oh, that's a great question. Actually, I have a colleague, a very highly experienced banker that has led a number of turnarounds for African banks and African non-bank financial institutions. And he's currently working, I think, with 5 Ghanaians saving loans in rural banks to improve their investment readiness. He has very good experience. So I'm going to ask my colleague, Jerry Montero, to take that. Jerry, tell us what you think is ALCO's role when thinking about the non-loan assets. So I think that's the investment portfolio.
Hi, good afternoon, everybody. And Donna and Nathaniel, thanks very much for involving me in this webinar. Actually, this is very relevant in today's environment in in Ghana. And there are two main points that come up here. One is how are the existing investments and bonds to be treated? And secondly, how do we invest our surplus funds? As Zibram mentioned right at the beginning, at the moment, if you look at the rural banks, he spoke about 60% of their surplus money or their balance sheet is in treasury bills and bonds. I was looking at, can you hear me properly?
Yes.
There's
Yes.
a little disturbance on the phone, on the webinar. But anyhow, I was looking at some particular institution, for example, the largest 4 rural banks in Ghana, and I was looking at a BT Banking Survey results, and it showed that if you look at Amin Fiman Rural Bank in 2021, their loans to deposit ratio was only 38%, and the balance was in investments. If you look at Atwima Kwanwoma, their treasury bills was 83% of their deposits. If you look at Otobari Rural Bank, their treasury bills, and when I say treasury bills, I meant treasury bills and bonds, was 68%. These are very, very high percentages. Now, the ARB Apex Bank has guidelines or benchmarks, and this says that about 36% of the balance sheet should be in primary and secondary reserves. A liquidity ratio minimum should be 40%, and advances to loanable funds should be 60%. There's no definition of loanable funds, and I'm more used to loans to deposit ratio. And in the example that you gave in your slides, you were talking about an institution having a target of 90 to 105% loans to deposit ratio. For me, that is an extremely high percentage, which I would not be comfortable on. That is a very, very aggressive percentage. At the same time, the benchmark of ARB Apex at 60%, I think is too conservative. And that scenario of ARB Apex's benchmarks means that around 40% of the balance sheet needs to be invested. And that is one of the reasons why the RRBs in particular and banking industry in general has had a very large investment in treasury bills and bonds. There are 2 newspaper articles and one by the Rural Bank Association, which talks about 753 million Ghanaian CDs in bonds, and a newspaper article talking about 2.24 billion CDs in bonds. This whole DDE transfer to new bonds has made a big difference to the existing bond portfolio. Now, while the relevant regulatory authorities have said that the new bonds will qualify as liquid assets and for capital purposes under the regulatory and prudential requirements, which is very, very good. But nevertheless, it will have a great impact on interest, bringing their interest down, because on the new bonds, the interest rate is between 8.35% and 10% for bonds which will mature in 2038. And even at the short end, which is 8.35, the institutions will only be paid 5% until February 2025, and the balance will be given to them in new bonds, additional bonds. So the interest income is going to go down, and that is where your ALCO report on the interest rate scenario and the effect, I think is very important for institutions to see what is going to be the effect on the interest rate. And the second thing on the existing portfolio is the provisions that will be required, because with the interest and the tenor being higher and longer, the discount will be much higher on the valuation of the bonds. In fact, on the euro bonds which are not being replaced, there the bonds are now discounted to basically 40 cents on the dollar. So they're discounted already 60%. So provisions are going to be very high. So this is what will happen on the existing portfolio. On the new portfolio, the add-on surpluses that will get generated in the balance sheets of the savings and loans and the rural banks have got to be invested. Investment opportunities in Ghana are very, very low. There are not too many opportunities. At the moment, a lot of investment is done in treasury bills, and which are issued by the government of Ghana, and in notes or bills which are issued by the central bank. The central bank notes are for much shorter terms, whereas the treasury bills are on 91, 184, and 364-day terms. The interest rate that they are getting on the treasury bills are averaging around 35%. Now, that is a very high cost that that Ghana is incurring. And for example, in the last 3 months, the total treasury bill purchases have been in the order of 33 billion cedis, and the actual interest cost to the government was 4 billion cedis. So that scenario cannot on treasury bills continue. The government will start lessening the amount that they take on treasury bills once they get the $3 billion from the IMF. But the second aspect, second area where institutions can invest are the new bonds. The new bonds will now start getting, will start being available on the Ghanaian stock market through the financial center page, and that will be very liquid. But other than that, there are not too many institutions, there are not too many investment opportunities. And that is why financial institutions need to build their capacity to lend more in the market. 30, 35, 38% loans to deposit ratio is too small. Even they need to try and come up to the 60% benchmark at least, and they need to have capacity building to do that. They need to invest in digital technology, because that is the only way forward for them. I hope that gives you a little bit of a scenario where they need to be looking at.
Yeah. Thank you so much, Jerry, for such an awesome explanation. So one of the questions that is coming from the savings and loans end is that there are not much exposed to the currency risks. So can you give a possibility? Oh, I'm not getting a question correctly.
Yeah, I get it. What they're asking is they don't have currency risk. So probably should we even be looking at it? You know, that's interesting. You asked this question because the financial institution I'm working with now, their currency is pegged to the euro and they don't have any currency risk either. So they asked me outright, do I need to do this report, Donna? Why are you making me do this and think about this? And I said, okay, once a year, I want you to be looking at the currency risk and thinking if your balance sheet has changed. Just have the form ready, understand what it means. And if you don't have any currency risk, everything is in local currency, that's great. But if you do have anything that sits, liabilities or assets in another currency, you have to be just filling in this form and thinking about it and setting limits. So promise me just once a year to do it.
Okay, thank you, Donald. So another question from the participants from the awesome presentation you have is that, can you give a clear distinction between stress test and scenario analysis?
I don't know who that was, but that's a smart question because I probably should have said better. So Stress testing is scenario, but the way my client, the one I showed you, because I actually showed you a client, I won't say where or who, their stress and they called it stress and their stress testing and scenario analysis. So in their distinction is that like a scenario analysis is more likely what's going to happen in the next 12 months, like let's say with interest rates, okay? So they said likely they thought, okay, interest rates may go up 1 percentage points, but we probably won't change the interest rates on our loans, but the debt we're getting from the banks may go up. So they did what they thought was an actual realistic scenario. That was like their scenario analysis. A stress is when you're stressing it out, that you don't expect interest rates to go up 2% or 3% or 4%, but you have to stress it. In the US, the regulators made us stress our balance sheets and our income 4 percentage points up and down. Every quarter we had to do that and report that out. That's a stress scenario where you don't think it's likely, but you got to push and see what actually happens.
Okay. Okay. Thank you for the clarification. Another question coming in from one of the participants that he said that he works at the tier 4 microcredit institution, and then should look out for in the. Let me ask the question. I would like to ask about what the tier 4 microcredit institution should look out for in the A&L management, considering the fact that they work with their own funds and are not deposit taking. Can you address this question for us?
So actually, because I work with a lot of non-deposit taking financial institutions, so you're using debt and equity to fund your loans and fund your assets. In one way, it can be easier because you don't have to understand a depositor is going to take their deposits out, what their behavior analysis. Usually with your debt, whatever investors or banks that are providing your debt, you know your maturity, you know your agreed upon interest rate kind of changes if it's a variable rate. So you can actually plan that out. You would also be talking to these providers of debt early on, you know, if they're going to probably 3 months beforehand renew the debt. So you have to understand more. What you have to understand is if your microloans, your borrowers, how often are you refinancing? You know, how often is that client, you know, has their 8th loan? Are they going to get their 9th loan? So that money's going to go out the door. So you got to look more on it's a little bit more, I wouldn't say difficult, but you have to take in more considerations when you're looking at your assets to understand that. But you have a bit better, clearer understanding of what your debt is renewed. So for me, when I'm working with non-deposit taking institutions, it's understanding the debt and if that's going to roll over or be renewed. Unfortunately, you also have less when you're working on your contingency planning. You know, you can't go out and try to get more deposits in to fund if you have some kind of issue with your assets, you know, liquidity. Your source is going to be debt, right? Getting a line of credit if you ever need to get any liquidity quickly. So hopefully that answered your question.
Okay, thank you so much for the clarification. So the time for our webinar is up, and then I'll just ask for one last question from the participant. But before that, Donna, there's this question that says that does a very small institution really need an ALCO? As one of the slides show, the Bank of Ghana recommends only an officer coordinates asset liability activities. So does a very small institution really need an ALCO?
Jerry, I think that's a great question for you, since you've been working with a bunch of different size institutions in Ghana. What do you think? ALCO needed for a very small institution?
So before I answer that, let me come back to your slide where you spoke both about ALM and ALCO. To me, these are two different items. ALM is the whole asset liability management process. ALCO is the committee that looks at it. So where the central bank says for smaller institutions, you don't need an ALCO, but you need what they call a representative or something of that sort. The point is that ALM is required whether you're big or small. The ALM is need is not just for regulatory purposes, but it structurally helps the financial institution to manage its liquidity, solvency, what you call gap analysis, I call duration risk. Also, its profitability, its performance against plan, against what they have done. So irrespective of the size, you need to manage your business, and the ALM process gives you a module in order to do that, number one. Number two, the central bank has already asked everybody to give the ORAS reports, and those are very detailed, and they give you the wherewithal for your ALM process. You don't need to do anything major in addition, new reports. You might need to have some of these in a higher level in order to have a discussion. So while you may not, a smaller institution may not require an ALCO, they definitely need to have ALM and discuss it at their monthly executive committee meeting. And it should also be discussed at the governance board level. Because the board responsibility on overall risk management of the institution includes developing a risk framework, as you also mentioned, and that risk framework takes into account all these risks, and they need to advise the central bank how they are managing the risk. In terms of the savings and loans, the central bank has got a separate corporate governance disclosure directive. Without an ALM process, they cannot do that properly. You spoke about the risk management for rural banks, which speaks about smaller institutions not needing an ALCO. Such a clause is not there in a separate risk management document that the central bank has given for banks and savings and loans. So in summary, I think even a small institution should look at an ALM process, even if they don't have a separate ALCO committee that meets regularly. But it should come in the management. In fact, even the document of risk management, that same 6.4 clause, which says smaller institutions don't need ALCO, earlier they're talking about a lot of the frameworks that are required by that institution. And so to me, ALM is required, but a specific ALCO committee for a smaller institution is not required. And what is smaller? If you take the savings and loans in Ghana, there may be one savings and loan which has a balance sheet of over $100 million. If you take the largest rural banks, I don't think there's any rural bank which is more than 50 million US dollars. So how small is small? Are we talking 5, 10? But they still need to look at ALM processes.
Thank you, Jerry.
Okay, thank you, Jerry. So the bottom line is that a very small institution should consider ALM. That's great. So another question from the participants is that, is the risk management framework document different from a risk management policy?
Well, are there policy, are there benchmarks and limits in your risk management policy? That's the question. What I'm going to give you is this fund management and policy, which is the ALM portion of your risk management policy. But look what's in it and just see, maybe you already have this developed. I don't want you to redo everything to make a funds management. Just check what I have limited and what's said in my policy is in your risk management. And then you can see it's the framework part is the benchmarks limits. Nathaniel?
Thank you, Donald. So Ernest and Frederick have raised their hands in the webinar. I would like to allow them to talk and ask their question if they are online. So Ernest, please, you are allowed to talk. Can you unmute and ask your question? Frederick, please, you're also allowed to ask your question. Yes.
Okay, yeah, good afternoon.
Good afternoon.
Good afternoon.
Good afternoon,
Yeah,
can I
please,
hear you?
I would like, yes, please, I would like to make some inquiry. With respect to the ALCO committee, are there specific benchmarks that need to be considered by the committee? Are there specific benchmarks?
The specific, yeah. The specific ones are what your regulators tell you. That's the specific ones you always have to adhere to, right? Regulators rule, we used to say in risk management, the regulators rule. So whatever they tell your capital requirements, liquidity requirements, liquidity reserve requirements, those are the specific benchmarks. What I'm going to give you in my funds policy, an example, you'll see some other benchmarks that I think are very good to adhere to. And next week, when we talk about liquidity, I'm going to give you a lot of liquidity benchmarks. And again, we can talk about which ones are interesting, and then the management can decide. But the ones I showed you today about cumulative gap is pretty much a standard type of benchmark. But check out the funds policy that you'll get, okay?
Okay. Thank you. Ernest, please, you are allowed to talk. Can you unmute and ask your question? Okay, so I've seen Collins. Collins, you are allowed to talk. Can you unmute and ask your question?
Okay, good afternoon, and thank you for allowing me to ask this question. I think the question probably will go to Gary. For some time now, I think Ghana economic environment has been very tough for managers when it comes to managing, asset and liability, as we are discussing. My question is, now you go for ALCO meeting, and this simple question: Treasury bills, government instrument that people more or less at the time, we say they were free for us to invest in, as against going to lend money to SMEs, individuals that are not able to pay. Where do you stand now? What should managers do now? Because now we are scared that if you put your money in government treasury bills, you don't know what decision government is going to take. Looking at what has been happening in the past, it comes and say, now we are bringing you to the new bond market, where if you move in there, liquidity becomes a challenge, because money that we are taking short term, 1 month, most of our investment, 3 months, 6 months. Why should I go and put it in 10 years, bond, portfolio? It doesn't work. Maturity, as the lady talked about, maturity profile will catch you up in terms of the gap. So what should managers be doing now in Ghana?
Okay.
Donna, you want me to answer that?
Yes.
So I think, number one, there is a difficulty of possible investment avenues for surpluses of savings and loans and rural banks today in Ghana. If you go back a few years, a lot of the surplus went through brokers, finance houses, and you saw in 2018, when the central bank closed down a lot of these institutions, all that money was lost. Even today, about 470 million CDs are still locked up and not come back. So you really are left with treasury bills and bonds. And that's an unfortunate position, because liquidity is so high and credit deposit ratios are so low. So the answer is, in part, as part of your diversification, is to increase lending and increase your actual credit deposit ratio towards the 60% benchmark that you're already permitted. And that is good for the institution if you can build your capacity, because I don't think one has to say that loans will not be paid. It's the improvement in the underwriting process that is required, and the need for capacity building and the process in which, and you have to look more at cash flow of the institution, not just a security, because if you only take a security and let's say land, the day you have given that loan, to me, is the day you got a bad debt on your books if you have not looked at the cash flow. So you need to build capacity to lend and increase your credit deposit ratio towards the 60%. Therefore, your surplus to be invested goes down. Number one. Number two, after what the government has done regarding the bond market, the domestic bond market, I don't think, and I think the general, there is a general acceptance that they are not going to do anything like that with the treasury bill market. In fact, the finance minister has come out very categorically and said this will not be done, and treasury bills are, he used the word sacrosanct. In addition, treasury bills are of much shorter duration. The only treasury bills which are being auctions which are being held now are 91 days, 182 days, and 364 days. And the Bank of Ghana has bills of 14 days and 56 days. So these are all very short-term investments, and you've got to live with them. The government needs the treasury bills. Ghana needs the treasury bills until this whole DDEP process is finished and the new bonds, the A, B, and the general bonds are put in the secondary market. Once they come into the second, so I think the treasury bills and the short-term Bank of Ghana bills, 14 days and 56 days, should be a proper and acceptable risk. Otherwise, you just have to sit with your cash. And having lost interest on all your old bonds, you can't afford to doing that. If there is no income coming, you're going to have a major problem. Once the new bonds come in and they become liquid on the stock market, or in the particular financial side of the stock market, Ghana cannot do anything much to that. At that time, the treasury bill availability will definitely diminish, because as I mentioned earlier, the government cannot afford a 35% cost on treasury bills. So, and new bonds will not be issued by the government, at least for a 6-month period. If I remember right, in the memorandum, they've committed that there won't be any new bonds issued for 6 months after they are listed. So that is the avenue. But to me, one of the major areas for emphasis, and I'm repeating it, is to increase your lending. That is what you set up savings and loans or a rural bank for. You did not set up the rural bank or the savings and loans institution or the promoters in order to invest into government bonds. So financial institutions have to start building the capacity to lend to customers. And take it that the MSMEs are about 90% of the institutions in Ghana, and a very, very high percentage of the GDP is based on them. They contribute to the GDP, something like 60%. So therefore, one has to find a way to give to MSMEs and also to the agri sector. I mean, today we have in Ghana tomatoes that can be grown and exported. There's a new paper that came out that Ghana can earn 120 million pounds by exporting tomatoes to the UK. Poultry is not being purchased in Ghana, it is being imported. So these industries and agri sectors need to be supported. But again, I will emphasize, capacity building is required in order to profitably lend to MSMEs and the agri sector without incurring bad debts. Donna, you may want to add something to this.
No, I think you made a good point about the lending, smart lending, good lending, cash flow lending. Thank you, Jerry.
Okay, thank you, Jerry. That's a great exposure. So another question says that by the organogram in the side involve board subcommittee and the board. Are we wrong for not involving the board?
So
Yeah.
I think, okay, so I think maybe my picture was not right. It didn't look right. So no, this committee is in management, but they should be reporting up or giving the reports and their minutes up to the board if there's any decisions. And in some cases, for example, if you're not within a benchmark, like I'll show you with a liquidity contingency plan, then you have to report immediately to the board if you're not within, if there is a medium risk or high risk scenario with your liquidity. So you are not wrong. My picture was wrong, but you should always, the board should be getting your minutes. If you have a risk committee of the board, they should be getting your minutes and your reports also, at least a summary of the reports.
Okay, thank you so much for all the questions. With this, we will be closing the webinar. So thank you for attending today's webinar. Like it was said earlier, the webinar was recorded or is being recorded, and then we share the link to the recording to you, plus the presentation and other materials that Donna promised. So again, once again, this webinar is a part of 4 series, and you can see on the screen the other 3. The upcoming one is next week, liquidity risk management, followed by strategic risk management, and then effective risk management. Thank you again. And with this, we will be closing the webinar. Bye-bye.
Thank you, all of you.
So Elaine, it's left with just you and I. Wow.
Somebody could turn off the recording. So, I mean, given every